Hello everyone, this is TobeTada with another video of crypto trading. Thanks for checking by and let's dive right in. So for today's video I thought I'd speculate a little bit about the Dow Jones Industrial Average Index and what we can make up here in terms of if we apply Elliott wave theory. Like I've said before, I'm learning as well, and there's a lot of information about this on the internet, so if you have any comments or ideas, let me know. I'd be really happy to hear that. So for today, you can see that there is basically, I've laid out the chart which goes back to 1915 to the current period here now, here with TradingView, and you can basically see that the price in general, of course, has been going upwards tremendously if we look at this very large time frame. Now, perhaps the first thing I want to speak about is the scale type. So if we look at this here, this is currently a logarithmic scale, and if we change it to a linear scale, which is how charts are often looked at, you can see it changes tremendously. We basically don't really see any big changes here prior to 1987. It's almost basically flatlined, and after that you can see there's this tremendous increase. So from about 900 to 26,000, that would be about, well, yeah, 2,600 increase in price. And the problem with this scale is that you don't really see what's going on in this part here, or this part that looks like there's nothing going on, basically, because there's no real movement, so to speak. But that's not the case. Excuse me. That's not the case at all, because if we change back to a logarithmic scale, or perhaps let me basically draw this in here. So basically we said this is the part that doesn't look very interesting. Now if we switch to a logarithmic scale, you can see that's not the case at all. So this is basically, sorry for the bad drawing here, but you can see this is basically what I highlighted before, and you can now see very clearly that there's something going on here. And in fact, the great stock market crash of 1929 is clearly visible here, which is not something that's visible in the logarithm and the linear scale here. It's just a blip, basically. And so because we have this tremendous increase in the last 20, 30, 40 years, you might not notice these little changes that actually are quite large. Because in 1929 we had an all-time high of about 370, 380, and then it dropped down to $44. And so if you look at that, that's basically a decrease 80, 89%, almost 90%, and also an increase of about 600%. And so it's very important that you play around with these scales and don't really get stuck in this linear mode, and also check out the logarithmic scale here. And if we have a, if we interpret this here, you can, in terms of Elliott wave theory, we could say that here, prior to the stock market crash here, we can quite clearly see an impulse wave here, which is basically where the price increased here. Now, of course, stock market goes back a little bit further, so I don't have the data here. So from what I'm reading right now here, I want to focus on this impulse wave here. And I thought I'd compare that a little bit to what's going on to the previous cycle, because you can see that I've also drawn in an impulse wave here for the current cycle we're in. And I guess call this here the time frame. I think this would be like a super cycle. or perhaps grand supercycle, because it's going on for basically 100 years or a little bit longer even. And you can see that after the stock market crash, there was basically the first wave going up to 180 and going back to about 100. And I read in a book that this is basically how some people charted this, the Dow Jones going to almost 1,000 in about 66, and then about crashing down to about 567 in 74. And that would be a 1, 2, 3, 4, and then this would imply that we are basically have an extended fifth wave here. So what I mean by that is that the fifth wave is much longer than the third wave here, or the first wave, because the first, the third, and the fifth wave can be extended. And we actually see that quite similarly with the prior to the stock market crash. We see a 1, 2, 3, 4, 5, in which the fifth wave here is also extended. And for the current cycle, it's even more extreme here. You can see clearly here the fifth wave is extended. And so I looked at it and I thought I'd compare it a little bit, and because of course we now have a lot of news with another recession looming, and the last time this basically happened was in 2007, 2008 here, when we had this crash here, which looks quite small actually if you look at it in a big time scale, but nevertheless it was a decrease of about 52%. So not quite as bad as the great stock market crash of almost 90%. Now, of course, if you know a little bit of Elliott wave theory, you know that after an impulse wave, we have a corrective wave. And so the question is, will we see an equally extreme correction as we saw in 1929? I think that's what a lot of people have been talking about. And so that's basically what I guess I'm pointing to at, because we have the similarities here with an impulse wave here, and indeed it could look like we could have a corrective wave going back down again. Now the question is, of course, when does this happen, and how far does it go? Because if Elliott wave theory is correct, we should see it. Now if this continues to go up for another 20, 30 years, I guess you could always somehow argue that this is still an extension, but within Elliott wave theory, we should definitely see a correction sometime soon. And so I thought about looking at the fifth wave here, the fifth wave a little bit more in detail. And so I have a chart here, a little bit zoomed in. This is basically from 1929. You can see here also the time frame. And this is basically the zoomed in version, the 1, 2, 3, 4, 5. And I think my cursor isn't showing here, so sorry for that. And I want to focus on the last part of the fifth wave here. You can see I drew in a 1, 2, 3. And now this is clearly very speculative, but I thought it looks quite similar to what we have right now. So if you look at that 1, 2, 3 before the peak of the fifth wave, I think that looks quite similar to what we have currently. So what I mean by that is, if we zoom in to the current wave here, and I'll switch to weekly chart here, put back on auto, and I think you're right. See what I mean here. Hard to adjust it, so let me check. You basically see a quite similar pattern here. So on the right here we have the current chart for 2019. going to 2019, and you can see in the last year there was basically the stock market didn't continue to rise as much as it did before, since we had the last recession here. And so you can see these 1, 2, 3 peaks here that I drew in, and I think that looks quite similar to what we saw in 1928, 1929, when we saw the stock market going a little bit further up and then basically kind of crashing. And because also these the impulse wave looks quite similar, we have this extended fifth wave, I thought it would be interesting to notice. Now, it doesn't mean really that this is going to happen, of course, but we do know that patterns do repeat in stock markets and everything that we're basically trading. So if this continues in the same way, then we should have basically another strong impulse wave up here, and then perhaps reaching about 30,000, 32,000. I wouldn't say too much further, perhaps 35,000. And after that, you can see there is a very strong correction, so it would have to go down here. That's basically if the pattern repeats itself. And I think that's just quite interesting with these 3 peaks here. Now the question, of course, is how much of a correction are we talking about? And I think if we look at the past corrections, we could kind of make that out by, for example, looking at the Fibonacci ratios. And I'll draw in one here for the correction of the second wave here, the current impulse wave. And you can see the correction went down to about, sorry, I think I have to, yeah, now you guys see it. The correction went down to about a ratio of 0.618. Now we can actually apply this to the correction of the fourth wave as well. So it's up here as a 1, and then we have the 0.786 here. It kind of went down to about 0.786. And now the question, of course, is what happens if we apply that to the current impulse wave? Because then we'd have to start here, 1929, and drag it up here, current time, a little bit more because it's probably going to rise. And then basically have the 1 up here, perhaps actually a little bit further up. Something like this here. Say it's going to be something like here. So you can see the ratio of 0.786 in terms of Fibonacci ratios would mean that it would bring us back right back down to the last recession here. It would be about 7,400. Now, because in the past the market has corrected itself to the 0.618 and also almost to the 0.05 areas here, we could basically argue that the correction would go perhaps something like so. Now that might not look that much in terms of the chart here, but if we look at the decrease here, it's quite a lot actually. So if we start up here at about 30,000, already going back to the 2009 levels would be a 75% decrease in price. So that's actually quite major. And then to think it would go even further is definitely taking it to the extreme. But these 90% is actually exactly what we saw in the great stock market crash in 1929 here. That was also a 90% decrease. So it's definitely not something that couldn't happen. And that would bring us to the 0.618 ratio here. So about, what would that be, 2,500? So if there is some chance of repetition here, I think we could see a correction in terms of a big correction, we could see a price range of 2,500, 7,500, something like that. And of course, this is clearly speculation, but I thought it would be interesting because we have these very similar impulse waves and these peaks that I pointed out, and if you look at the chart, it definitely looks like we're ready for some sort of correction, because it's unlikely to continue to go up and up. So let me know what you think. I hope this was interesting, and see you next time. Bye.